Bismillahirrahmanirrahim. Dear students, today's lecture is for the class of BCom Part 2 students, and from Part 2 BCom we will discuss here the subject of business finance, and in business finance we will discuss the topic of ratio analysis. As you know, my dear students, that the entire syllabus of business finance is particularly relating with the corporation or company. As you know, there are three forms of businesses on the basis of ownership: sole proprietorship, partnership, or corporation. But we, for the purpose of business finance or for the purpose of ratio analysis, we will discuss only the corporation, the form of organization. Corporation is different forms of business as compared with other form of business like partnership, like sole ownership, etc. Ratio analysis is conducted after preparation of the financial statement. After preparation of the financial statements, at the close of fiscal year, we prepare the financial statements, and after preparing the financial statements, we can conduct the ratio analysis. Ratio analysis is one of the part of total financial analysis or financial statement analysis. When we want to conduct the financial statement analysis, we have a different analysis tools. We may conduct the analysis through trend analysis, through common size analysis, through time series analysis. Just like that, there is one of them is a ratio analysis. So here we discuss only about the ratio analysis. Before discussing the ratio analysis, first of all, we have a somewhat know-how about the financial statement. Financial statements may have includes different things like income statement, balance sheet, cash flow statement, but we here particularly discuss the income statement and a balance sheet. So we want to know about the items of income statement, because these items of income statement and balance sheet are literally will be used in the ratio analysis. In income statement, in simple format, we have a first of all net sales or sales revenues. From sales revenues, we will less cost of goods sold. Then we got the gross profit. From gross profit, we will less selling and admin expenses. Selling and admin expenses. Then we got net operating profit. You may say earning before interest and tax. That is a very important term used in finance, EBIT. Earning before interest and tax. You may say the income statement, net operating profit or operate. From gross profit, we less the selling and admin expense. Then we got net operating profit. You may say operating profit, or in finance, we may say EBIT, earning before interest and tax. From EBIT, we will less the interest expense. We will less the interest expense, and then we got earning before tax. Earning before tax, EBIT, or you may say net income before tax. From EBT, we less the tax expenses relating with the current year. Then we got the net income, or you may say net profit. If we don't have a preferred stocks, this final answer may be called as a earning available for common stocks. So this is the net earning, net profit, net income of the corporation. So this is a very simplest form of the format of income statement. Just like as we have also a balance sheet given for the purpose of conducting ratio analysis. In balance sheet, as you know, we have our assets, we have our liabilities plus stockholder equity. In classified balance sheet, there are so many headings, there are so many types of assets and liabilities, but on a basic level, for the ratio analysis purpose, we have a simplest form of balance sheet having a following three major types of assets: current assets, intangible assets, and we have a fixed assets, and then we got the total. Just like as three headings on the credit side of the balance sheet: our current liabilities, our long-term liabilities, and last one is the part of shareholder equity, and then we got the total. So this is our income statement and balance sheet, which is given for the purpose of preparing the so financial statements, income statement, balance sheet, these may be given to conduct the ratio analysis. Ratios, basically ratio analysis is conducted to compare ourselves with our previous past performance or compared with the performance of other companies in the market or compared with our competitors. So to conduct the comparison with our previous, with our competitors, with our market, we conduct the ratio analysis. For convenience, we can divide the ratio into four following types. First ratios type is called as liquidity ratios. Second ratio type is called as activity ratios. Third one is called as debt ratios, and fourth one is called as profitability ratios. So these four types will be discussed one by one. First of all, we conduct the liquidity ratios. Liquidity ratios. So our liquidity ratios means a firm's ability to satisfy its short-term obligations as they come due. So in simple words, we may say these two segments, these two items of the balance sheet will be under consideration for the purpose of liquidity ratios. So under liquidity ratios, we can calculate current ratio. Current ratio may be calculated as total current assets divided by total current liabilities. It means this part of the balance sheet, total current assets, will be divided by this part, total current liabilities. We will divide the current assets over current liabilities, then we got the current ratio. So this figure of current ratio may be then compared with our previous performance or compared with the performance of our competitors. Second one is our quick ratio. Quick ratio, for the purpose of calculating the quick ratio, we have a quick assets divided by total current liabilities. Total quick assets will be divided by current liabilities. Now question is that what we mean by quick assets, how we calculate the quick assets. So quick assets we can calculate from our current assets if we less the inventory. Current assets includes so many items like cash, like inventory, like bank balance, etc. So if we less the inventory from current assets, then we got the quick assets. If these quick assets are divided by current liabilities, then we got the quick ratio. So these are about liquidity ratios. After discussing liquidity ratios, now we are going to conduct the second type of ratio analysis, that was activity ratios. That was activity ratios. Activity ratios measure the speed with which various accounts are converted into sales, cash, inflows or outflows. It means total activity, right from purchasing the raw material, converting it into the work in process, finished goods after selling, accounts receivable, then cash. So whole process is activity of the business. So from this activity, we have different ratios under this heading of activity ratios. Number one was inventory turnover. First ratio under activity ratio is inventory turnover. Inventory turnover can be calculated by CGS divided by ending inventory. If CGS divided by ending inventory, then we got the inventory turnover. Inventory turnover is always measured in terms of times. How many times inventory is, let me say, got to be sold. After inventory turnover, then second thing which can be calculated, that is average collection period. Average collection period, or you may say this may be called as a ACP by abbreviation. ACP or average collection period is calculated as account receivable divided by sale per day. Sale per day, or you may calculate the sale per day by dividing the sale into 360 or 365 days as per your current year. After ACP, we can calculate average payment period. Average payment period. This is, you may say, in reverse of ACP. This may be called as APP as an abbreviation. One thing, average collection period of time needed to collect account receivable. How many days, how many time needed to collect the cash from our receivables. As in contrast, in average payment period means the amount of time or days required needed to pay the accounts payable. What amount of days, what days are required to make the payment of our payables, that is called average payment period. For calculating the average payment period, we have accounts payable divided by purchase per day. Divided by purchase per day. So then we got the average payment period. So the frequency of inventory turnover is in times, but frequency of ACP, we can calculate the ACP or APP in terms of days. So in days we calculate the APP. So there are maybe some other ratios under activity ratios. Total asset turnover. Total assets turnover. Total asset turnover can be calculated as total assets can be calculated as sales divided by total assets. If we divide the sale by total assets, then we got the total asset turnover. Total asset of turnover can also be calculated in terms of the times. Then receivable turnover or account receivable turnover. Account receivable turnover can be calculated as sales divided by account receivable. So then we got the account receivable turnover. This turnover will also be calculated in terms of times. After discussing two ratios, we discussed activity we discussed activity ratios and liquidity ratios. Now we move to the next types of ratios, that was debt ratios. That was debt ratios. Debt ratios, as its name implies, these are relating with the debt, these are relating with the liabilities, and liabilities have its two types: current liabilities and long-term liabilities, and also relating with the internal liabilities, which is called as shareholder equities. So under debt ratio, number one, we have a debt ratio. We have a debt ratio. Debt ratio can be calculated as total liabilities divided by total assets. So it means this is a direct comparison of total assets and total liabilities. So then we got the debt ratio. Second one, times interest earned ratio times interest earned ratio. Time interest earned ratio, it may be called as a debt service coverage ratio. So we can calculate time interest earned ratio by this formula: earning before interest and tax. This term is used in income statement. EBIT or operating profit or net operating profit, it is divided by interest expenses. So EBIT means earning before interest and taxes can be calculated by dividing the earning before interest and tax by the total interest expense of the period. Then one another ratio in that ratio is fixed payment coverage ratio. Fixed payment coverage ratio, fixed payment coverage ratio. We can calculate fixed payment coverage ratio by earning before interest and tax, EBIT, or you may say operating profit, plus lease payments divided by interest expense plus lease payment, and also add in the denominator principal payments plus preferred stock dividend, and this portion is divided by the 1 minus t. So this is how we can calculate the fixed payment coverage ratio. So in this way we can calculate the fixed payment coverage ratio. And fourth ratios are our profitability ratios. As its name shows, these ratios are aligned with the profit. Profit are of many types: operating profit, gross profit, profit before tax, and a net profit. In profitability ratios, first ratio will be our gross profit ratio. That will be our gross profit ratio. Gross profit ratio can be calculated as gross profit divided by sales. If we want to answer in percentage, then we have to multiply the answer with 100. After gross profit, we have a operating profit ratio or operating profit margin. Operating profit margin or operating profit ratio can be calculated as net operating profit or EBIT divided by sales multiplied with 100. After operating profit, we have a ratio to calculate net profit margin or net profit ratio. So net profit ratio can be calculated as net profit divided by sales multiplied with 100. After net profit ratio, there is a formula for EPS. EPS stands for earning per share. That is a very important tool to measure the financial performance of company, especially investors when they, you may say, compare all the securities available in the market in their portfolio, then they take their decision on the basis of different things, but especially on the basis of earning per share. Earning per share, net profit minus preferred stocks dividend, or you may say earning available for the common stocks divided by the number of common shares, divided by the number of common stocks. After earning per share, we have a next ratio, that is a ROA or ROI, that may be called as return on assets, return on assets, or it may be called as return on investment, ROI, or it may also be called as the earning power. Its formula is net profit over total assets multiplied by 100. This is the ROA. But if we want to calculate ROE, return on equity, return on shareholder equity, return on common stockholder equity, ROE can be calculated as net profit over shareholder equity multiplied with 100. So this is all about ratio analysis. So in next lecture we will inshallah learn anything more.